Interesting, I think, discussion here today on the national mortgage settlement and what it means for NSP grantees. And with me here today is really a prestigious, very knowledgeable group of presenters. In addition to myself, Craig Nickerson, the president of the National Community Stabilization Trust, we have Tasha Harris, our program director for the trust, Damon Smith, who's a senior counsel to the General Counsel of HUD, and has been a leading expert and contributor to the development of the national mortgage settlement as well as the implications going forward. He's still very much engaged in that discussion. And we thought it would be important to have the state perspective here. The state AGs, of course, the attorneys general, were instrumental in this effort. And we have Dina Levy with us, the special assistant to the New York Attorney General. And, of course, our friends at HUD are here with us as well today. Hunter Kurtz from the NSP office, John Laswick, and David Nagura, I think, are all joining us. Let's talk about what our objectives are today. And we're gonna try to make this as interactive as possible with our four speakers. We want to give you an overview of this national mortgage settlement, what it entails, highlight some of the key terms of the settlement so that you're, if not an expert, at least well-versed in how it's working and who it engages and how they're engaged. We're going to specifically examine the anti-blight or community anti-blight provisions of that settlement, which are, frankly, sometimes misunderstood, and what the good news is there in terms of helping to support your community stabilization efforts through NSP. And also point out some ways that you as grantees and your subrecipients can work with servicers, at least those 5 key servicers that are immediately impacted by this settlement, to ensure that it does work to your benefit and not to your detriment when it comes to your local revitalization efforts. And I might add a fourth here, a last bullet as well under objectives, which is because of Dina's presence here, we're going to have a chance to examine how one state is taking this new settlement and carving out some programs and practices that will help their state with their community stabilization and other housing issues. All right? So let me just start off, before I turn this over to Damon here, with a little bit of the overview of what is this national mortgage settlement. You've probably heard it referred to in many different ways as the AG settlement, or perhaps the 5-servicer settlement, or the top servicer settlement, or the mortgage servicing settlement. A lot of different terms for it. The term that seems to be sticking that I think everybody would prefer is used is national mortgage settlement. It's a landmark piece of legal settlement between the state attorneys general, 49 of them, and the top 5 mortgage servicers in this country to resolve some claims that related to some alleged mortgage servicing abuses and unfair foreclosure practices. It's a big deal. It's $25 billion in monetary sanctions and homeowner relief approved just a few months ago. Many of the provisions in here go well beyond the dollars themselves in terms of better practices. And it's one of the largest, frankly, financial settlements ever, and certainly the largest multi-state settlement since the Master Tobacco Settlement back in 1998. And so what we're going to talk about today is some of the key elements of this, and we'll narrow down to some of the elements that are particularly relevant for you given what you're doing day to day to restabilize hard-hit markets. But before we go any further, why don't I turn this over to Damon Smith, and Damon, who is there as part of the negotiation, can help us walk through some of the key elements. And Damon, let me just start by saying thank you. Secretary Sean Donovan and his senior team, including yourself, were really instrumental in making this happen at the 11th hour.
Oh, well, thank you very much, Craig, and thank you for all of you who are participating for your interest. And I'm going to walk through certainly the slides that I believe were provided to you that you have in front of you, and so I won't belabor all of the points that are on there, and to ensure that we have plenty of time to answer questions at the end. The genesis of this settlement, as described on slide 5, is that the state attorneys general certainly became engaged in looking at mortgage servicing in approximately October 2010, when a number of press reports came out regarding the use of robo-signing by these banks in terms of how they process foreclosures through state court. And for those of you who aren't familiar, the basic concern that was raised by this is that there are a number of affidavits and assignments that are done in the process of servicing loans that require the affiant to have personal knowledge of information. And what we were seeing is, and what the press reports highlighted at that time, was that a number of institutions, banking institutions, were processing more foreclosures than could possibly be done by somebody who is claiming to have personal knowledge of what's actually in the loan files. And that personal knowledge is required under a number of state laws, specifically to ensure that a person is foreclosed upon properly and the person has been given all the due process that they need. At the same time as that was going on, and actually predating it somewhat, at HUD here, our Federal Housing Administration staff and others were reviewing servicing compliance with our regulations and statutory requirements for mortgage servicing for FHA-insured mortgages. And what we were finding was a number of problems that were also implicated by what the state attorneys general and others were finding as they began their probe later in 2010. And that is the type of lost paperwork, the problems with borrowers who were being both foreclosed upon at the same time as they were trying to receive modifications to their loans, or perhaps they were in a trial payment plan, and the fact that when they called their servicer to get information, they often would be bandied back and forth between different departments at the servicer, and would have very little information or opportunity to make sure that they were getting every opportunity to avoid foreclosure. And of course, as the Attorney Generals recognize, and as you all recognize, the concern that we all have about that is the incredible destabilizing effect that these types of foreclosures have had on both the families, obviously, that are involved directly, the neighborhoods that they are in, where we see housing values dropping when a foreclosure appears on the market. And there was a recognition that while mortgage servicing did not cause the housing crisis, that these types of activities that we're describing certainly exacerbated and perhaps lengthened the crisis unnecessarily. So a bipartisan negotiating committee of attorneys general and of federal participants, including, of course, the Department of Justice, HUD, Treasury, and from time to time CFPB, and certainly on a going forward basis CFPB, which had just been formed by that point, was put together in order to talk to these banks about what problems we were finding. I think on the next slide you'll see what banks we're talking about. They are Ally Financial / GMAC, Bank of America, Citigroup, JP Morgan Chase, and Wells Fargo. And one of the reasons that this is important, obviously, to borrowers is not every borrower out there could be helped by what benefits we'll be describing later are in the settlement. It is only the borrowers whose loans are serviced by or owned by these institutions that ultimately will be able to benefit from this particular settlement. There are ongoing negotiations with other servicers, but as of now, the only 5 institutions where these types of efforts are relevant are to these particular 5. There's important to distinguish what's in the settlement, which we'll be talking about in great detail coming up, with what's not in the settlement. This does not in any way, shape, or form prevent the ongoing investigations that state and federal entities are involved in regarding residential mortgage-backed securities. This did not release any criminal liabilities or any fair lending or fair housing claims or claims against the Mortgage Electronic Registry System, also known as MERS. Going on to the next slide, I think we can quickly pass over this one, the financial obligation by servicer. It looks like this is a table simply pulled together based on the documentation that was included in the consent judgments for each of the institutions. But the 5 key elements that I want to focus on is the financial relief that is provided as a part of this settlement. So it's $25 billion is sort of the headline number. That can roughly be divided into $5 billion in cash payments, $17 billion in consumer relief, and $3 billion in that in additional consumer relief above and beyond that 17 that is provided for refinancing of current homeowners. So the next slide here that we're on slide 9, defines some of those, the scope of some of that relief for struggling homeowners that the settlement provides. So the $20 billion includes at least $10 billion in principal reduction. What this does is that for borrowers who are delinquent and underwater, meaning that their unpaid balance is larger than the value of their home, one of the mechanisms of keeping folks in their homes that just had not been explored in any volume at the time of the settlement was not just reducing interest rates, but actually reducing the principal owed by those underwater borrowers to both get them into a payment that is sufficient, that they have sufficient income to continue to make on a going forward basis, and at the same time reducing any incentives that there might be out there for a borrower who's so significantly underwater that they don't see any chance of getting equity in their home over any number of years, to actually bring them within a relatively close distance of being able to be above water and be able to rebuild the equity that they had lost in their house. In addition, there's refinancing assistance. I had mentioned $3 billion. These are for underwater borrowers who are current on their mortgage. So the problem that we're seeing, and certainly there's legislation on the Hill that's being pushed rather strongly that will help more people refinance their homes who cannot take advantage of today's historically low interest rates simply because they owe more on their home than they are able to owe more on their home currently than their homes are worth. And the result of that, obviously, is you either, if you tried to refinance and you had to put down, get to a 20% equity stake and you're already underwater, you would have to bring such a significant portion of funds to the closing table that it's a great disincentive to even try to refinance. And one of the steps that we have taken in order to help people do that is for these 5 banks, they are providing $3 billion in refinancing assistance to borrowers who are in those categories. There are other homeowner assistance that is under that $20 billion. Up to $7 billion are for other forms of relief. Obviously, refinancing to help people get above water and principal reduction are designed to help stabilize the housing market, and particularly in as you can imagine, in those communities that were hard hit and continue to be hard hit by foreclosures and people walking away from their homes. The other types of assistance includes opportunities to avoid a foreclosure, but it happens mostly in those instances where the borrower cannot remain in the home. So a significant portion of that $7 billion will undoubtedly be made up of short sales or deed in lieu, cash for keys. I think it's been called a number of types of methods that helps the borrower to transition from a home ownership to whatever their next housing opportunity is, but does not have a foreclosure hitting the market. In addition, it also provides forbearance for unemployed homeowners, so that is a way to keep people in their homes. If a borrower is unemployed, so there's no modification that will get them during the time of unemployment to an affordable payment, it's an incentive that for the banks to be able to extend that forbearance beyond the sort of traditional 6 months that we had seen. There are service member protections, and in addition, there are anti-blight programs, as are described here, which largely can be described in a couple of different ways, but I think it comes up in a subsequent slide. Yeah. So moving on. The state and federal government payments were made, as I mentioned, $5 billion. Approximately $1 billion of that went to the bulk of the $1 billion for the federal government went to the Federal Housing Administration to cover losses that may have been suffered as a result of material deficiencies in servicing. The Veterans Housing Benefit Program at the Veterans Administration and the Rural Housing Service at the U.S. Department of Agriculture also received payments out of that fund. There's a separate set-aside for borrowers who were foreclosed upon between 2008 and 2011, where they can apply for payments as a result of servicing that did not give them, for example, opportunities for loss mitigation, opportunities or alternatives to foreclosure, where they were unable to get the type of response from servicers that is expected under the servicing standards, that is the non-monetary portion of the servicing settlement. And it's anticipated that that will be up and running. It's being run by the state AGs, and then it will be up and running later this summer in terms of providing information to borrowers about where they can apply and how they can apply. The anticipation is that payments wouldn't be made out of that fund until probably the first quarter of 2013. But the payments, given the number of foreclosures that occurred and the number of people that it is estimated would fall into the category of being eligible, is somewhere between $1,500 and $2,000 per borrower. It's recognized that that is not adequate compensation for anyone who was foreclosed upon improperly, meaning they either should not have been foreclosed upon because they did not owe the outstanding balance that they were accused of, or that they were foreclosed upon by a wrong entity. And so nothing in the settlement requires them to give up any private rights of action that they may have against these institutions. Finally, the state payments, and I think certainly Dina from the New York AG's office can speak more authoritatively to this, but there were $2.5 billion in direct payments to the participating states in the District of Columbia, designed to provide repayment for funds that may have been lost as a result of servicer misconduct, and to fund the types of foreclosure prevention and alternatives to foreclosure that have been described elsewhere in the settlement.
Great. Thanks, Damon. Tasha, perhaps you could start us with the overview of how some of the state funding is being slated for housing activities or not slated for housing activities, and then we'd love to hear from Dina about the state of New York's approach.
Oh, great, thanks. So as Damon mentioned in the previous slide, there were 49 participating states that received direct payments in the amount of $2.5 billion. And Enterprise did a great study. The link is down below at the last bullet, looking at the ways that the states plan to use the money. And the states, you'll see, have a lot of discretion in how this money will be applied, because kind of the definition governing the use of these funds was a bit broad. The only kind of stipulation was around the civil penalties. No more than 10% could go towards civil penalties. But it was suggested that the money should go towards like housing-related foreclosure prevention activities. So in Enterprise's study, which was updated June of this year, this was kind of the initial information that they were able to uncover in terms of 26 states are using most of their funding for housing-related foreclosure prevention efforts. But you'll also see that some states are really undecided or have decided to not place their funds towards housing community development activities. And you'll see that on the next slide, go down. This is also from the Enterprise study, where it's a graphical depiction of how the states are using their money towards housing. So this would be a good time for me to introduce Dina Levy with the New York State AG's office. So Dina, how is New York planning to use its settlement dollars? It would be interesting to hear a real-life application of how these funds will be used.
Sure. So first, let me just say thank you for having me on the call. And just as an overview, let me say that I'm very proud to report that New York Attorney General Eric Schneiderman has, expressed and is now carrying forward a deep commitment to making sure that the hard dollars that New York received as part of this settlement will all flow in one way or another directly to ensure that homeowners and communities affected by the foreclosure crisis are somehow aided. And so I think we've been thinking about how to do that in sort of 3 areas. So I'll just quickly give an overview of those areas and then give a little bit more detail. So the first is our commitment to making sure that housing counseling and legal service providers across the state are able to continue functioning and in some cases are able to expand those services so that every homeowner or borrower and in some cases renters who are affected have access to high-quality housing counseling and legal services. And so we've sort of done that in 2 ways. The first is we had a fairly robust state program and city program that were operating historically, and both of those were scheduled to sunset. And so the first thing we did is we allocated some of our funds to just bridge existing counselors and legal service providers through a period while we were then simultaneously working on a competitive request for applications on a much bigger program. So I think we committed about $15 million early on just, again, to keep those who are already providing these services, to keep those doors open. And we are now deep in the middle of, we've already, with actually Secretary Donovan, we had a public announcement back in June about the release of this request for applications, and we are committing $60 million over a 3-year period through this competitive request to both legal service providers and housing counselors. We anticipate that those new dollars, so the first round of the $60 million, will be flowing on October 1st. And so we're moving on a fairly tight deadline to make sure that there's no gap in services across the state. The second area that we're thinking about, and I think actually these two relate to one another, and I'll talk more about it, is what we've been calling enforcement, but I think after listening to Damon, I think the better way to describe it is what I would call proactive consumer relief. And so part of our goal is to make sure that in that sort of credit world that Damon walked through in terms of consumer relief, principal write-downs, refinancing, short sales that are beneficial or have a dignified outcome for the borrower, we want to make sure that New York borrowers are sort of moving to the front of that line. I think it's pretty clear to everybody on the call that though there's this sort of minimum requirement for what the servicers have to do in terms of the credits that they're vouching for, it's not geographically divided, right? So, it's just, I think each state needs to be mindful, and New York is certainly doing this, that, we're getting the most needy families to the front of the line and making sure that they're proactive. And one way we're hoping to do that is to sort of, simultaneously as we're doing the kind of case-by-case through our housing counseling and legal services networks, we're also looking for opportunities to aggregate and think about bulk sort of approaches to the banks so that we're doing more than one of these at a time where possible. I'll give an example of how we're doing that in a second. But the third, and so I do want to go back and just make the more direct connection between the benefit of having this network of robust housing counseling and legal service providers across the state will be a way for us to start to pull in the information that we want so that we can do these sort of more creative things around proactive consumer relief. And so we see sort of a double benefit of investing some of our dollars to that program. And then the final piece with funds that will be that have yet to be allocated for anything, we are looking at, I'd say, a large number of different opportunities for holistic community revitalization programs. And we are, to some extent, I think, still in the research phase on this, and we have not totally settled on an idea, but we are looking very much at some of the things happening around the country that have been effective and productive in terms of both homeowner retention and community revitalization. So we're looking in some cases at, bulk note sales or creating a facility that could execute note sales. We've, looked at a program in Pennsylvania that's a bridge loan program for unemployed borrowers. We've looked at land banks and community land trusts as opportunities, and I think we'll continue to do that, though I would say in the next few months we hope to be sort of more clear about which, or, we might do more than one, but which of these ideas we're going to put forth and execute on. So I think that's a pretty good explanation. I'll just say the last piece is on this sort of middle one that I talked about, which I think is a very high priority for us, because as I've gotten to know sort of how this, and the housing counseling community and the legal services community should get a ton of credit because this is such an unbelievably difficult task, and they're just doing this constantly one at a time, and it can be very frustrating for them too. I would say that the more we can think about how to sort of get at this problem in bulk ways, and whether that's through this this proactive consumer relief idea, or whether that's through these sort of innovative like bulk note sales, I think for us, one of the things we really want to see is if we can use some of this money to really, get to scale and have an impact in one or more of the most affected communities across the state.
That's great, Dina, and a really good summary. We're going to open it up for questions in a little bit here after we get through a couple of the other key elements, and I'm sure there'll be some questions about the New York State effort. But one of the reasons we asked Dina to speak and to highlight the New York experience is that they're not only continuing to support some ongoing important efforts like counseling, but we're especially intrigued by some of this incubating new ideas, whether it's the note purchase execution or community land trusts or other facets of this. This funding is sufficiently flexible that there are a lot of opportunities for an inventive Attorney General's office, and certainly in New York you have one. So thank you for you and your Attorney General for making that happen.
Great.
It also, by the way, go ahead, Dina.
No, I just said thanks.
Oh, I was also going to say that, Dina mentioned note purchase, and that might be particularly relevant now that FHA has announced a note sale execution that should be another springboard for community stabilization around the country. All right, well, let's go back to our list. We had some key elements of this national mortgage settlement that we were highlighting, and one of the most significant, Damon, is this mortgage servicing reform, this series of, maybe they're intangible, but important best practices, or maybe another way to describe it, Damon, would be to improve the consistency and transparency of servicing standards that those top servicers will be utilizing. Can you walk us through that?
Absolutely. Thank you. And I think it's important to highlight here that obviously it was not sufficient to be able to extract, say, penalties or even consumer relief alone and allow the servicing practices that led to the robo-signing controversy to continue. And so it was very important that we have a set of rules of the road and in some way, shape, or form fence in the behavior of these servicers so that they would not continue to exacerbate the problems that started with the housing crisis. And so there's a series of over 300 very specific servicing standards that were negotiated as part of this settlement. And I certainly want to give credit to the attorneys general who took the lead on that, along with the bankruptcy trustees at the U.S. Department of Justice, and obviously the New York Attorney General's office was absolutely instrumental in making sure that we put in place servicing standards that would protect consumers on a going forward basis, as well as the types of compensation that we were talking about. Obviously, some of the servicing reforms are, to stop the practices like robo-signing, the provision of improper documentation in courts, both on the foreclosure side and on the bankruptcy side, and to end the endless lost paperwork saga that was preventing borrowers from getting opportunities to avoid foreclosure altogether. And so some of that is accomplished through, among other things, the provision of a single point of contact, the investment of the resources necessary by these servicers to be able to properly provide information on a timely basis to consumers, the creation of a loan portal that is designed to allow for the electronic provision of papers by borrowers, and also provide an outlet for them to be able to look and see what the status is of their modification request, or where they are in their terms of payments on their trial modification before they are able to get permanent mortgage relief and to help stay in their homes. So these are the types of things that are included in those servicing standards. An end to that dual tracking type process, or at least a significant amendment of that dual tracking process, whereby a borrower might be both referred to foreclosure and going through modification trials, where the banks will have to stop the foreclosure referral process for a period of time in order to give the very clear communication with the borrower that the bank is working with them and that they have an opportunity, if they meet the requirements, to avoid foreclosure altogether. So those are some of the important mortgage servicing reforms, and there are some that are very specific to neighborhood stabilization that I'll mention a little later. One of the fourth components of that we wanted to highlight today was certainly there are a number of benefits to service members and veterans that were negotiated largely by some of the state AGs, including Delaware's State Attorney General Beau Biden and the Department of Justice and others, which was to end some of the foreclosure practices that were in violation of the Service Members Civil Relief Act. There is a look-back process that the Department of Justice's Civil Rights Division is overseeing that is designed to make sure that the practices, both on a going-forward basis and on a backward-looking basis, were in full compliance with the SCRA. Among the things that SCRA provides is that military personnel who are given a change of station or who are taken, let's say, into a combat role, can't be charged interest in charge of excess of 6%. And obviously, what we found in our investigations were that the banks were, in fact, violating that requirement. In addition, when there is a permanent change of station and a service member obviously has to move somewhere else and is in the process of selling a house, particularly in this particular market environment where a house might sit for a little while longer, many of those service members were struggling to make payments on the home that they had and obviously make the payments they would need to at their new station. And so if a service member had a home that was foreclosed upon in violation of the SCRA requirements, part of the look-back process the Department of Justice is doing would require a rather extensive compensation for borrowers that would give them back any lost equity that they had in the house, as well as $114,000 above and beyond that if they had this SCRA violation during a permanent change in station. In addition, it's not mentioned here on the slide, but the service members have a more extensive opportunity to engage in short sales where they have a permanent change in station as a result of some of the provisions that are in Exhibit D to the consent judgment.
Damon, before we go on to talk about, I want to ask you in a minute to talk about the scoring system itself, and we've got an example or two on coming up here. But, you know, a lot of times we get asked the question, okay, this applies to 5 top servicers, the ones you mentioned, Bank of America, Chase, Citi, Wells, and Ally. But what about other servicers, or for that matter, what about the GSEs? How broad might this be viewed, or is this going to be, do you think, limited to the 5 that are currently engaged?
So the state attorneys general and the their federal partners are actively engaged in discussions with that will have to remain confidential for purposes of this call, but discussions with 9 other servicers. And so the goal is to get to as broad an array of servicers as is possible. And certainly, you know, we would hope to have additional servicers that are signed up to the servicing standards and who are providing some version of the types of consumer relief that are described in this settlement as well, certainly before the end of the year. You know, having said that, obviously those negotiations are what they are, and if those institutions prefer to go a different route, then certainly you'll see court cases instead of a settlement described as a result of that. You're absolutely right, though, I think, to point out that the folks who will benefit from this settlement are, again, those whose loans are owned by these 5 institutions and serviced by these institutions. And it is a significant portion of loans that are serviced by these institutions. Some 60+% of the overall loans that are serviced are serviced by these 5 institutions. However, the GSE loans, because principal reduction is not allowed to take place on GSE loans, those are Fannie and Freddie backed loans, which is a significant part of the market. they are not borrowers who have loans that are owned by those institutions are not eligible for the benefits that are described under the principal reduction. Obviously, if a servicer wants to reach into their pocket and buy down one of those loans, they're welcome to do so. But we would anticipate, for obviously economic reasons, that largely this is going to be loans that are owned by these servicers, and then to a lesser extent service for others that they are doing.
Great. Well, let's move on then to this scoring system. It's confusing to some how this works, and there seem to be different levels of credit given for different activities. And maybe we could ask you to start with just how does the scoring system work? How does it relate to the amount of the obligation for each of the 5 servicers?
Well, it's an important point to make. Exhibit D to the consent judgments that were signed by the servicers and these releasing institutions, government institutions, describes the full set of consumer relief that's available in some detail. It includes an Exhibit D1, which is a table that describes how much credit banks will get for undertaking certain activities. And this slide 15 gives a just brief overview of some of those examples. And what you'll see is that, although you won't see it on this, but if in the full Exhibit D1, largely the banks do not get dollar-for-dollar credit for every activity that they engage in. So, for example, if a bank was to write off a second lien loan that is more than 90 days late in terms of its delinquency status, they would only get 50 cents credit for every dollar written down. And the purpose for that is that the cost to them, the actual sort of economic value of that loan to them, isn't the same as a performing first lien loan, or a first lien loan, let's say, that is not particularly underwater. So if a borrower is over 175% LTV, meaning the loan-to-value ratio, the loan outstanding balance is 75% greater than the actual value of the home, then the bank has a somewhat less of an expectation of that dollar coming in the door as that borrower continues to make payments, simply because that borrower may have an incentive to sell the home or leave the home and engage in some sort of short sale or other activity, as opposed to a borrower who is very close to being above water and has the opportunity to see the light at the end of the tunnel, and those borrowers obviously are paying going delinquent at a lower rate than those who are significantly underwater. And so these differentiations between credit and dollar amount is sort of can make your head hurt just in terms of looking at the math. And I specifically went to law school to avoid math. And so the thing that I think is probably the most salient point to take away from this is that the actual amount of activity that the banks will engage in is greater than their absolute obligation. So let's take it just for instance in the $20 billion range. In order for the banks to get across the panoply of options that are available to get credit against their $20 billion obligation, we're likely to see greater than $20 billion in actual activity, because you don't get dollar-for-dollar credit for each and every activity that you engage in. And so that's just significant in the sense of letting folks know that the scale of this actually could be greater than just described in the $25 billion.
And Damon, is it your sense, before we move off of this the scoring system, that the 5 servicers are to some extent still wading through the individual activities and the quote-unquote credit that would be attributed to each activity to figure out what their choreography looks like?
I think that's right. I mean, they just recently, under the terms of the settlement, had to submit work plans to the monitor, and when I know we're coming to that later, but Joe Smith, former North Carolina banking commissioner, former president of the Conference of State Banking Supervisors, is the monitor who oversees the compliance with this settlement. they have a work plan giving some sense of how they are rolling out, for example, the servicing standards that I described earlier in terms of making system changes, doing training, hiring additional staff, whatever's necessary to comply with those servicing standards. And they have, under the terms of the settlement, until October 1st to be able to meet all of those servicing standard requirements. On the consumer relief side, they certainly are engaged in some of what I would call the sort of high-dollar mortgage modification and refinance requirements. Each of the banks it was required to solicit folks in their book who are in their portfolio who are eligible for the refinancing option, and so we're seeing those solicitations going out. Two of the banks, Bank of America and Ally, were required to solicit significant portions of their servicing portfolio in order to attain additional above baseline, above sort of minimum modifications for interested borrowers on the principal reduction side. And so we're seeing those types of solicitations go out from each of the institutions. And so those, what I describe as just sort of high-dollar, high-value consumer relief, we are seeing rolled out, and certainly hope later in the summer to be able to provide some window into what kind of consumer relief was accomplished based on their pipeline between March 1st, when they could first start getting credit, and June 30th, which would be the first quarter of work that they did.
Great. Well, let's talk about the anti-blight provision a little bit here. We promoted it at the beginning of the session, and it obviously has direct relevance to what many of you are doing day in, day out. And it's mostly good news with some aspects that may be still TBD, to be determined, or gaps that we can help the five services figure out more effectively. There is language in the agreements for each of the five that is fairly specific. It couldn't have been much better written, I don't think, if any of you wrote it, in terms of covering some of the major facets of what you do. You see it covered here in some of the bullets on this slide 16. But if I could, let me literally read for you what that paragraph says, and then we'll talk about the implications. And this is a paragraph now from the settlement term sheet under the general servicer duties and prohibitions. It says, servicer shall develop and implement policies and procedures to enhance participation and coordination with state and local land bank programs, neighborhood stabilization programs, nonprofit redevelopment programs, and other anti-blight programs, including those that facilitate discount sale or donation of low-value REO properties so that they can be demolished or salvaged for productive use. That's a mouthful, I know, and if you were trying to write it down, I'd probably talk too quickly. But let me emphasize some of the operative components of this requirement. Importantly, the AGs did highlight the importance of land banks, neighborhood stabilization, nonprofit development-type programs, in the broadest sense, and that's very good news. The pieces that actually have a direct relationship to some credit, and if we can go to the next slide, I think we have a summary of it, are these three. Forgiveness of a property's principal, where the servicer doesn't pursue foreclosure. I'll come back and cover these in more detail. And that's as Damon mentioned, not all of them are a one-for-one credit. This is a 50-cent credit for every dollar of property value. And that's for forgiveness of a property's principal, where the servicer doesn't pursue foreclosure. So one could argue this is the potential walk-away, the charge-off, where the servicer chooses not to pursue foreclosure, and to the extent that they are contributing it to neighborhood stabilization, there's a 50-cent credit there. Cash costs paid by the servicer for the demolition of the property. That's a one-for-one credit. That's important. So you may see an increase in servicers that are not only contributing a property, donating a property to a locality or a nonprofit at the local level. There may be a cash payment or a check, if you will, that comes with that helps to pay for part or all of the demolition costs. This is for actual demolition. And then thirdly, REO properties donated to municipalities or nonprofits or to disabled service members or relatives of deceased service members. So you heard Damon talk about some of the emphasis upon veterans, here it covers not only that, but the NSP type efforts around the country. To the extent they donate property, whether those are very low value property or properties of more significant value, they're going to get a one-for-one credit. Those are important components that the 5 servicers could make a component of their overall response to the settlement agreement. The cap, the maximum amount that can apply to the overall credit for that institution is 12%, but leaves a lot of wiggle room there. That's the good news, and I think we're already seeing some, and we'll talk more about this in a minute. We're beginning to see more of that happening in the marketplace, more donations, higher value donations. We're beginning to see some of the services talk about some funding to help support the demolition of very highly distressed properties. And that'll all be important to your neighborhood stabilization efforts. What is missing here, at least for now, and it's not to say that the services aren't willing to consider this, are some of those other things that I mentioned a minute ago. Neighborhood stabilization program support more generically, support for land banks, the kinds of work that are associated with the acquisition and renovation of property. Natasha, we could go back to slide 16 a minute. You'll see here that one of the key components here is that to the extent the servicer is helping with discounted properties, as in the First Look program, where they're conveying property below market value to an NSP grantee. There's no direct credit for those at this point in time, but there certainly is the encouragement for the services to undertake those kinds of efforts, and we certainly would hope that going forward there'll be a robust discussion with the 5 servicers about how they plan on implementing those provisions. If we go to slide 18, we talk about some of the ripple effects in the marketplace here, and just briefly summarize some of these. I've made some reference to this already, but the settlement scoring system and these anti-blight provisions are impacting the way that services will be engaged in neighborhood stabilization going forward. A lot of work still needs to be done by the institutions to figure this out. More emphasis clearly is going to be placed going forward on pre-foreclosure solutions. And frankly, I think we've all come to the conclusion that the best neighborhood stabilization strategy entails a more robust loan modification strategy to keep more of these families in their homes in the first place. Another ripple effect is we will see more emphasis on donation of properties, including properties of value. One of the major servicers here, and they haven't done a press announcement on this, so I'm going to hold off mentioning the name, but one of the major servicers participating in this national mortgage settlement has already developed a rather robust program to donate properties, including properties of real value in excess of $25,000. And that becomes another form of subsidy that can complement your NSP funds. So you can use your NSP funds for, as you know, for acquisition, renovation, for down payment assistance, for many activities. But if you're able to obtain properties that have some value, let's say $25,000 of value, at no cost to you, that's another inherent subsidy that can be used to help facilitate the revitalization, the reuse of those properties. Demolition, which is a big factor in some communities, should get a boost from the National Mortgage Settlement. And importantly, there is this increased emphasis. We've already seen it with veterans groups, but this should be another boost to helping our returning veterans with their housing needs as well. Before we talk about what all this means for grantees, Damon, maybe you made reference to it earlier. Joe Smith is going to be overseeing this monitoring and enforcement Could you maybe talk a little bit about what that role entails?
Sure. I'll be quick. One of the main differences between this settlement and prior federal or multi-state settlements is that it has a rather robust monitoring provision in it. I mentioned already Joe Smith and his credentials, who has been universally described as tough but fair, and is in charge of overseeing this effort to make sure that the banks meet all of their obligations under the terms of the settlement. The banks actually pay his salary, the salary for his staff, and the salary for primary and secondary professional firms that he engages with in order to assist him in overseeing the sort of numbers crunching and other types of work that are necessary to make sure that the banks are meeting their obligations. He does have the ability to both publicly in reports that will start coming out in the first quarter of 2013, to be able to name and shame, if you will, by describing what banks have missed what requirements in the servicing standards, or perhaps are have asked for certification of their consumer relief, but have been turned down because of problems in the types of consumer relief or the method of providing consumer relief. If the banks do not, in the next quarter, correct whatever mistakes have been made that he had pointed out in a previous report, he has the ability to impose penalties of up to $1 million. If they continue to have the problems in subsequent quarters, he can impose penalties up to $5 million for those violations. So the settlement does remain in effect for 3.5 years, so until end of 2015, just the very beginning of 2016, his last report would come out. But servicers have a strong incentive to get their work done, certainly within those 3 years, and an even greater incentive to get it done within the first year. There's basically a 25% bonus that the servicers can get for principal reduction and refinancing assistance that's provided in year one, meaning between March 1st, 2012 and March 1st, 2013. In addition, they will be penalized in a sense if they don't complete their work within the 2 and 3 year timelines that are described here. 75% of the work in year 2 by the end of year 2, 100% by the end of year 3. So that would be April of 2014, April of 2015. Basically, any outstanding obligation that they have would turn into a cash payment. And would be 140% of whatever outstanding amount there is due as a result of that cash payment.
Great. So what does all this mean for grantees here? We're going to open it up to questions in just a minute. But just to sum up, grantees should clearly look at the settlement as another potential resource. And I think what it's going to do clearly over the next couple of years is help accelerate the sort of linkages between loss mitigation and neighborhood stabilization, the keeping people in homes, families in homes, as well as dealing with the highly distressed properties that have become REO. So those linkages will be greater than ever. And I think the consistency of approaches among those 5 servicers, as Damon mentioned, some of those servicer practices are going to ensure that there's more predictability to what we see on the ground. There's a chance for us to weigh in with the 5 servicers as they try to figure out what each of these provisions mean to them and how they gear up to address those aspects of the agreement, anti-blight in particular. And certainly on the donation front, it's important, I think, for communities to figure out how or if they want to absorb more low-value distressed assets, donated properties, and who within their community might do that work. And then as far as the National Community Stabilization Trust involvement, we're working with some of those 5 servicers who are beginning to roll out an expanded donation program. You can almost call it a donation program on steroids, to get more property to communities to be more of the essential assets necessary to revitalize a neighborhood. Less so in the future the one-off execution. We don't see that as being as optimal as a scenario where localities identify the local nonprofits or quasi-public agencies or even for-profit entities that can take properties at some scale, predictably over a period of time, and sometimes with subsidy, and try to revitalize those properties or demolish them as the case may be. We clearly see that's going to be a more significant component of many programs going forward, particularly where there's a concentration of low-value assets. And you see here on the slide that if you're interested in receiving donated properties, you could contact your senior asset manager or just email the trust at newbuyer@stabilizationtrust.com. Before we talk about any of the additional resources, maybe we could open it up to questions and answers.
Hi, Craig. There's a whole bunch of them. This is Jenny, by the way.
Yeah, and Jenny, I was very remiss in mentioning that NDC, the National Development Council, is really sponsoring this webinar. So thank you for behind the scenes following all the Q&A and helping us make this possible.
No worries. The first one comes from Ray, and my screen is very small here. So let's see. What is the status to allow GSE and government loans, friends, FHA, rural housing, and VA to be part of the settlement remedies?
So this is Damon. I can field that. So I'd mentioned, and perhaps after the email came in, that GSEs are not eligible for benefits under the principal reduction portion unless, as I mentioned, the servicers simply want to make that payment on behalf of the GSE. We certainly don't anticipate that. Somewhat similarly, certainly the VA, rural development, and FHA loans are specifically called out in the settlement as being eligible for the benefits. The difficulty is that the servicers have this obligation, and they can't apply federal or state payments as their basis for claiming some amount of credit against their obligation. And so in each of those instances, if there is a partial payment of claim, for instance, on an FHA loan, if the funds for that partial payment of claim come from FHA, the servicer who may have helped facilitate that doesn't have the ability to claim credit against their obligation for having induced or through the normal course of FHA's loss mitigation program, gotten FHA to make a payment. And so we don't anticipate a large uptake on the FHA side simply because, again, the servicers would have to reach into their own pocket to do it, and so they're more likely to do that on their own loans, or on loans that they're servicing for others where there's clear authority to engage in principal reduction.
Okay, as a follow-up to that, Ray is asking, do the servicing reforms, especially around foreclosures, being prohibited while a loan mod is in process for all mortgages with the 5 servicers, including GSE and government mortgages? So
the answer to the question is yes, but under existing requirements. So the GSEs, for instance, in the course of these negotiations, after meeting with the state AGs and the federal participants, changed their servicing standards and servicing requirements through their streamlined servicing process, whereby they tried to bring Fannie and Freddie's servicing standards into alignment and have adopted essentially the same type of framework that's described here in the servicing settlement as a requirement on a going-forward basis for Fannie and Freddie serviced loans. Similarly, there's already a loss mitigation waterfall, for instance, that FHA borrowers, and I understand from having done presentations with them, certainly VA borrowers, servicers for VA and FHA borrowers have to go through prior to going through foreclosure, and it requires outreach to the borrower very early in the delinquency process. And so these are the types of standards that the servicers need to abide by for those individual programs that encompass many of the things that are described in the servicing standards here.
Okay. Joe Honeycutt is asking, does the CFPB plan to adopt the servicing standards set forth in this agreement as a national standard applicable to all mortgage servicers?
So the CFPB is in the process of conducting rulemaking. I believe that they are required under Dodd-Frank to publish a rule on servicing standards in January of 2013. They certainly are aware of the servicing standards that have been negotiated here. We think they provide a strong basis for where the CFPB may start, but certainly don't want to in any way, shape, or form speak as if that rulemaking process isn't what it is, which is an opportunity for the public to engage, make comments, perhaps even some of the comments that have been described on this in this conversation by Craig about ways, for instance, where servicing standards could strengthen neighborhood stabilization efforts are the types of things that certainly I know CFPB will be reviewing and making a determination based on those comments as well as what exists currently.
We've seen a lot of collaboration, Damon, with HUD, Treasury, Department of Justice on the whole formation of this settlement agreement, but also subsequently to what it may mean going forward. It seems to be the case.
That's certainly the case. We've worked collaboratively on this. Many of the servicing standards, again, largely brought about by the hard work of the state attorneys general, build off of standards that Treasury has in the HAMP program. And as we mentioned, obviously we think it forms a nice basis for CFPB's consideration as they adopt a more broad-based servicing requirements for servicers going forward. So we work, certainly, one of the great things about this and one of the reasons it's a landmark deal is that we worked across federal and state lines, not always easy. We worked across silos in the federal government, which for those of you who've either worked here or have dealt with the federal government, is not always easy. And even worked across partisan lines in that of the 49 state AGs, 25 are Democrats and 24 are Republican.
Great.
Okay.
Any others, Jenny?
Yes. Gene Rags is asking, you stated under the payment for state and federal governments that $1.5 billion would be used for borrower payment funds, which provides cash payment for borrowers' homes that were foreclosed during what period?
So the period is 2008 through 2011. So that would be January 1, 2008 through December 31st, 2011. And again, that is a process that the state attorneys general are working hard to set up, and believe that information about that should be rolling out later this summer in terms of who the administrator is of those funds and how borrowers who have an interest may express that interest. And obviously, nobody wants to roll anything out until there is sort of a full application process and everything else available, so as not to provide information today that ends up not being useful until the full application process is rolled out later this summer or early fall.
Okay. Christine is asking, if the property's principal is forgiven, does the borrower keep the property? Please explain in more detail.
Sure. So principal forgiveness is yet just another tool in the toolkit for modifying loans to provide borrowers with an affordable payment that will allow them to have a sustainable loan on a going forward basis. So imagine, for instance, under current federal programs and certainly some state hardest hit programs, borrowers who find themselves in financial distress and unable to make their payments on their current loan, whether it be because it was an adjustable loan that's reset at a higher interest rate, or whether it was a person who was employed now has been cut back in terms of hours, but could afford a lower payment. What basically those programs typically had done is provide interest rate reductions, an attempt to get, say, a 7 or 5% interest rate down to a 4 or 2% interest rate even, in order to make that monthly payment affordable for the borrower and allow them to stay in their homes. Principal reduction is there's sort of two forms of it. One is a sort of earned principal reduction, whereby a borrower if they are able to make payments over a period of time on a somewhat modified loan, may have be able to, over the course of a year, 2 years, or 3 years, be able to have some of the principal that they owe forgiven in order to incentivize them to continue to make payments on a going forward basis. The other is a more straightforward, just immediate forgiveness of principal, whereby somebody who has a $100,000 loan, in order to get to an affordable payment, may have $30,000 of that loan forgiven and then owe only $70,000. One thing that we've required in this settlement is that the loan must be current after 90 days in order for the banks to get credit. And the reason we did that was to incentivize sustainable modifications that will allow a borrower to continue to make payments, turn a delinquent loan into a current loan, and allow the borrower to stay in the property and not have another foreclosure on the market.
Clearly, the principal reduction, Damon, is helpful in those cases where borrowers are significantly underwater, and so part of the challenge here is not only the monthly obligation is daunting for that full unpaid principal balance, but it's the notion of there's no light at the end of the tunnel, and this affords them maybe a monthly carrying cost that's more affordable, and at the same time something that is more coincides with what the realistic values might be in the marketplace. Is that fair to say?
That's absolutely fair to say. I appreciate the assistance on that one. As I mentioned earlier, absolutely critical to making sure that we have a sustainable housing market going forward is to make sure that the borrowers who are making payments and are staying current have every opportunity they can to do so on a loan that where the outstanding balance approximates the value of the house.
Right.
Next question is from CP. His question, we have begun working with Chase on a property that has been vacant or boarded for 6 years. Chase never initiated foreclosure. Per the settlement, Chase could release the lien to the NSP grantee for $1, correct?
So the question is whether they would get dollar-for-dollar credit for releasing the lien under the provisions of the anti-blight provision. So this is one where their servicer is not pursuing foreclosure and they're forgiving principal on that property. So it's possible that they would only get 50 cents credit under the anti-blight provisions. It partially depends on both the status of the home. I would have to ask a few different questions, but and what ultimately the servicer is going to be claiming for credit because they want to put it under one bucket versus another. But as just a straight home that is forgiveness of the principal associated with the property because the servicer does not pursue foreclosure, that is a 50 cents credit.
Yeah.
Okay. Next question from Jesus. The banks will only donate those properties that are the most blighted and requires the most rehab. California jurisdictions will be hard-pressed to benefit as they will very likely do not have the cash for major rehab or a significant number of properties.
Yeah. Well, let me try to tackle that one. And I don't disagree with the person who posed the question or the statement there. In many instances, it would be simply taking upon yourself a problem that otherwise is not solvable by anyone else. So we don't want to convey, none of us want to see, as part of the settlement agreement or separate from this agreement, servicers convey their most distressed properties to another party that takes on the difficult challenge of trying to do something responsible with it and without the adequate resources. What we're hopeful of here is that the 5 servicers will see the benefit of conveying an array of properties. Sometimes they will be properties that need to be demolished because of the condition. In other instances, they will be properties in better condition where they can get the credit that Damon mentioned for that donation, a higher credit based upon the higher property value. What that affords the NSP grantee or subrecipient is the opportunity to get a mix of properties that helps underwrite the cost of the whole. This should never be a case of taking on the burden that someone else had without any execution plan. But we think in many instances from what we've seen so far, there is an opportunity selectively to take on a series of properties under an arrangement with that servicer that gives you comfort to know that there is residual value in the properties that you can leverage. It's going to be a case-by-case basis. I look at it as a complement to the NSP funding. We all know that funding is becoming more limited, although program income will play an important role. Well, that program income and NSP3 and other NSP funding can be complemented perhaps by some properties conveyed to you that have some inherent value, intrinsic value that helps you with the revitalization efforts. Won't always work, but we think it's certainly worth looking at.
Okay, in continuation, he asks, do the banks get credit for loan modifications that were completed prior to the settlement, and are those people eligible for any of these new efforts, or are they locked out?
The quick answer is the banks do not get credit for any modification efforts that occurred prior to March 1st, 2012. So to the extent somebody had a modification and they are in a sustainable payment as a result of that modification, they would not be eligible for additional modification or help just arising as a result of the settlement. That being said, somebody who was in a previous modification who, because of additional financial distress, finds themselves in a situation of needing additional assistance, there's nothing in the settlement that precludes them, because they'd received assistance in the past, at some unknown point in the past, from being eligible as long as they meet the minimum criteria. I think it's important to note, and I often don't say this because it seems like it goes without saying, but none of this is designed to benefit a strategic defaulter, somebody who can make a payment and just simply stops paying in order to perhaps receive a modification. It's absolutely designed and requires income documentation to back up any assertion of financial distress that would underlie a need for a modification. And so if a borrower who's in what had been a sustainable payment gets out of that situation due to unemployment, the banks, for instance, could extend a forbearance program beyond 6 months for that borrower and receive credit under the payment, notwithstanding their prior modification.
Okay, I got a question from David. Does the AG settlement apply to the subsidiaries of the 5 banks, such as Wells Fargo, MBS?
So the quick answer is that it applies to a number of both the releases that were received and the obligation and how it can be met applies to a number of sister organizations and affiliates. On a case-by-case basis, there has been some, controversy, and I don't remember if Wells Fargo MBS is one of them, as to whether or not it could apply to them. And largely what it is that we've had very clear language in the settlement that indicates that where there is an investor who in their pooling and servicing agreement have restricted the servicer's ability to perhaps provide principal reduction, there's nothing in the settlement that goes against that contractual obligation and would require the servicer to make changes to that loan. So I would have to take that as a question that perhaps we could email an answer from later and see if something about Wells Fargo MBS might fall into that category where there is, for unknown reasons, a restriction on what they can do in terms of providing consumer relief on that portfolio.
Okay, Bob is asking, since Missouri is not using the settlement funds for housing according to your map, can a servicer still use some of the blight eliminating actions, or does the state have to allow it before they can get the credit?
So there's an independent cash payment that was made to the state of Missouri, and the reason they're showing up on that map as I believe the color is red, is that the state of Missouri decided to use the vast majority of those funds, I believe, for restoration of some other general funds that otherwise would have gone to higher education, as opposed to using it for housing purposes. That is completely independent of the bank's obligation, and so any bank that decides to do undertake the anti-blight activities in Missouri, that would be completely eligible for credit, notwithstanding any use of the state of Missouri's cash payment.
Yeah, we should look at those state monies, those state allocations, as a fungible additional potential source of capital, as Dina mentioned in New York. there's a lot of flexibility for the states to determine how that is being done. Sometimes it's determined by the Attorney General office. Sometimes it is involving the legislature and the governor and other parties. It varies tremendously, both in the amount of funding, but also in how directly to a housing activity they've determined to use their funds. And Damon, you mentioned to me the other day on the phone that some of the additional states that had not yet made a decision have reached a conclusion since the enterprise study. California is one of those states we didn't have a determination. Has there been a determination there, or in Pennsylvania, New Jersey?
There has been. Certainly the vast majority of California's funds went for budget gap filling, I guess is the easiest way to describe it. But there was $18.4 million that was provided to the Attorney General for use in accordance with the suggestions in the mortgage servicing settlement. In addition, I believe that the Attorney General's office received additional funds that would, otherwise from the general fund for investigatory and implementation efforts related to this settlement above and beyond that $18.1 million or so. So there was somewhat of a divided use of funds there. The state of New Jersey, I believe, used the funds for to supplant funds that otherwise had been geared for housing already, and so as a result freed up some additional general funds for themselves, but didn't add additional value to the housing programs or efforts to prevent people from falling into foreclosure. And what was the third state? I'm sorry, Pennsylvania?
Pennsylvania, yeah.
I believe, and I will sort of look this up in the background as we're talking, that Pennsylvania used the vast majority of its funds to fund its Housing Emergency Mortgage Assistance Program, otherwise known as HEMAP, which is obviously based on the name, obviously, but in addition to, it was the source of federal legislation that was similar. Those funds are used to help borrowers who find themselves in a potential foreclosure type situation with emergency funding to keep their homes, and so that's obviously in the spirit of the language in the mortgage servicing settlement.
Okay. Tasha, you might, this might be an appropriate time to show the additional resources that are available, and if you wouldn't mind walking us through those 4 different items, particularly the first one is a wonderful website resource for this settlement.
Yeah, that's correct. So it's on slide 22 that everyone should see. So the National Mortgage Settlement includes a great executive summary on the settlement terms that we've covered in this presentation, as well as actual copies of the settlement documents for each of the 5 servicers, and other just a really good wealth of information can be found on the National Mortgage Settlement website. And then in terms of the National Association of Attorneys General, this is a good way to look up your state attorney general's information if you wanted to get more information on how they plan to use their settlement funds. Again, the enterprise report was updated in June, and as Damon mentioned, some of the information has been updated in terms of the state uses. So you could probably get current information from your actual state attorney general's office. And then this is a link to the Enterprise Community Partners Mortgage Settlement Report, and that includes both the map that I had in the presentation that we had in the presentation, as well as a table that lists the uses of the settlement funds by each state and how much their allocation is, as well as if they've come to a final determination and whether those funds are being used for housing-related activities. And then the last resource here, the National Conference of State Legislatures, includes a more interactive table of how each of the states plan to use their settlement dollars. So those are the resources that we have here for you guys.
Great. Jenny, before, I don't know if there's any other questions, but I sort of had one for Dina here. Dina, Damon and I certainly know you've reached out to the federal government and to the National Community Stabilization Trust for our input on what the state of New York will be doing. Are you seeing any sort of cross-fertilization, any sort of coordination, collaboration with the other attorneys general in other impacted, particularly the larger impacted states? Did we lose Dina?
I think so.
Maybe so. Okay.
Yeah, Dina had to get off early.
Okay. All right. Jenny, any other questions?
Yes, you have a couple more. Joan is asking if properties are donated, settlement funds can be requested for demolition or rehab. What about marketing of properties for resale?
So there's nothing in the text of the Exhibit D1 that describes anything about the use of funds for marketing in order to receive credit. It is literally tied to the cash value of the property that is donated, and so I would not anticipate that would be a creditable activity.
Not at all.
Ultimately determined by the monitor, so easy for me to say.
No, I'm sure that's the case, though. But beyond the settlement agreement, what we are beginning to see more and more from servicers is a willingness to help finance a disposition for distressed donated properties. And that may mean a grant to the nonprofit or to a government agency that goes along with the properties. It may mean a plan of action that is agreed upon between an MOU, if you will, between the locality and that servicer that involves a number of components, and it could conceivably include funds for the marketing. This is one of those cases where financial institutions, the servicers, find themselves between a rock and a hard place. Properties that are not worth continuing to sit on, either in REO or even in pre-foreclosure space. Something proactively needs to be done with the properties. They only get worse by sitting in purgatory. And so we're beginning to see more and more willingness to find a common solution. And part of that, of course, requires the servicer to be in touch with their investor. And depending on the servicer, that investor, there's a wide array of investors they service on behalf of. The two biggest, of course, would be Fannie Mae and Freddie Mac. Some of the servicers engaged here have said to us at the trust that literally 70% or more of their service on behalf of others, in other words, service on behalf of investors, is on behalf of the two GSEs. And there's still a lot of work to be done with the GSEs to figure out what the options are that are palatable to them and to their regulator, FHFA.
Okay, the next question is, what's the best strategy for approaching your state's Attorney General on how they will be using their allocation, state of Alabama specifically?
Certainly, my best suggestion is to look first, as I think had previously been mentioned by Craig or by Tasha, on the State Attorneys General website. They usually have some statement that was associated with either the March announcement of the agreement in principle or the the March filing of the consent judgments in federal district court, or the April announcement that the federal district court had entered the consent judgment that describes what their current plans are for using the funds. And obviously the contact information for the State Attorney's General Office would be there as well. Having said that, we've certainly seen, and as a federal employee, I cannot encourage people to lobby either their federal or state on issues, but we have seen certainly other instances where coalitions of folks approach the Attorneys General about suggested uses of funds, and oftentimes the Attorneys General Office appreciated the input. Some of them had a very formal structure whereby they solicited input, and others had a more informal structure. I don't have any information about Alabama specifically. It's possible that, again, all these funds are subject to state law requirements. Some states require that the funds go into the general fund, and the legislature determined how to use them. Other states give pretty strong plenary authority to the state attorney general to make a determination about the use of funds, and I'm not familiar with where Alabama falls on that spectrum.
Okay. Norman is asking, what impact will a forgiveness of principal have on the homeowner's credit report, and are investors eligible?
So I don't know the full answer to the first part of the question, which is principal reduction impact on the credit report. As I understand it, this is an issue that I believe Treasury has worked out with the servicers related to the principal reduction alternative provisions in HAMP. And so I want to say that it does not have an adverse impact, but because I don't have all the specific information, I would defer to our friends at Treasury and perhaps be able to email an answer to that question after I've managed to confer with them. In terms of are investors eligible, the requirements of the settlement is for occupied properties, and that was done purposefully. Although the vast majority of the benefits will likely go to owner-occupied properties, there was a recognition that in some states and certainly in some municipalities within states, you have a major issue with foreclosures of property that are single-family properties that are currently being used for rental purposes. And because that ends up with a displacement of a renter as well as a foreclosure on the market, it was very important, certainly, to a number of our state partners to make sure that those properties were eligible for benefits under the settlement as well.
Okay. Amy's asking, are there any funds available for property rehabs that go along with the donations?
I think, Craig, this goes to your point, so I defer to your answer on it, but certainly I think you accurately described it from my perspective.
Yeah, so I think that unfortunately the answer is it depends, but I think this is a work in progress, and so we're beginning to see a step up on in terms of a focus on donated properties and a growing awareness that sometimes other funds need to be made available for whatever the locality determines is the appropriate use. So in some instances, that may be for demolition. In other instances, depending on the nature of the market, it may be for renovation of the property. There's nothing in the settlement agreement or separate from the agreement that would preclude an institution from considering that. And, I think this is in that category, nothing ventured, nothing gained. We're finding that this is a very iterative process for the services right now. They're trying to figure out what makes sense from their standpoint, not only in the context of this agreement, but just going forward to begin to move along the process some of the loans that just seem to be stagnant, either in pre-foreclosure or in REO state. So you will see more and more of this, not only more and more property, I think you'll see more and more open dialogue with them, and feel free to reach out to the trust through your community development manager to determine what might be possible in your community. This has been a very active dialogue within our staff. We've also shared it with John and David and the entire HUD NSP team. Clearly this is going to be an important next chapter in our efforts to reclaim neighborhoods.
Joan is responding to a response that you had to her question, which I can go back and look for you, but she's asking, what is the walk away?
Well, I'll use, since I think I'm guilty of using the term, sometimes when a property prior to foreclosure sale has little or no value, and the servicer and investor look at that property and do the calculation that the cost of moving that property through foreclosure to an REO stage is prohibitively high given the value of the property in its current pre-foreclosure state. There has historically been a decision to simply charge off or walk away from your responsibility, I shouldn't say responsibility, from your your mortgage obligation or interest in the property. And that will continue to happen. I think what's important about the settlement agreement, one of the most important facets of the settlement agreement, as Damon mentioned, is that there's now some rigor, some procedures and requirements around when that does happen, when the economics don't warrant moving forward. You've got to notify people. It can't be done silently, and then a year later the assessor's office determines that that they need to be disposing of the property. There needs to be some greater transparency and notification. I think that's going to pave the way for a much more deliberative process by the servicers to get that property, not only to notify individuals locally that they're taking that action, but to then encourage the localities to do something proactively with the property. David, do you want to comment on that as an architect of the of that provision? Did we lose Damon?
No, he's on mute.
Sorry about that. So I thought I figured that one out, but certainly I don't have much to add. This was a provision that was very important to our state attorneys general partners, and was designed to cover exactly that type of situation where, as they described it, the property was in somewhat of a legal limbo in that the title to the property was still in the name of a person who had walked away. It ultimately is going to end up if there was a foreclosure process in the REO, but institutions were just letting it wait until the tax lien ultimately determined at a tax sale a new owner for the property at obviously a much lower value. And instead of letting properties fester in that situation and the negative externalities affect the property values of the neighboring of the neighbors, it made sense to provide credit for more proactive uses of those properties by the for proactive actions by the servicers, which is creditable, and also sort of servicing standards on a going forward basis to prevent that from occurring.
Stephanie is asking further information regarding scenarios where principal reductions might be eligible. What is the at-risk definition? In other words, does a borrower have to be delinquent in order to be eligible for a reduction in principal?
So the quick answer is that in most instances you would imagine that the borrower will ultimately be delinquent. The technical definition that's in the servicing standards in Exhibit D is that the eligible borrowers must be at least 30 days delinquent or otherwise qualify as being at imminent risk of default due to borrower's financial situation. So if the question is what's the sort of legal definition of imminent risk of default, to a great extent what was designed to be captured there was those situations where a borrower might be current but facing a mortgage reset and a adjustable rate mortgage that would make their payments unaffordable, and so due to a financial situation that currently could be projected, they would be at imminent risk of default in the coming days or months. And in addition, obviously there are those folks who have a bit of notice that they are about to have a large reduction in hours, and so people in that situation may be current but at imminent risk of default due to their financial situation, and this might be a method for the banks to get credit for capturing principal reductions that occur on those loans. Ultimately, any credit that the banks are trying to take, whether it be on a delinquent or a non-delinquent loan, would be subject to the monitor's determination of eligibility.
Jean is asking if you would put up the slide again on the anti-blight settlement provisions. And the next question is, can you expand on the anti-blight program of family members of deceased veterans eligible to receive donated properties?
Okay. Not having the screen up now. Is this slide 16?
Yes, it's up. It's up now.
Yeah.
Do you want to? You would answer.
Yeah,
I know
go
a
ahead.
previous question.
Go ahead, Damon. If you can, I'm still looking for it. I don't have the screen up at the present time.
Let me answer the second question first. The question seemed to be, is a family member of a deceased veteran eligible for a credit under the terms of the settlement? And the answer is yes. So REO properties, so those properties that the banks own that are donated to and accepting relatives of deceased service members could be eligible under the terms of the settlement. There's not a great amount of specificity in the settlement in terms of language beyond that, but I think what was described sounds like a creditable activity. I'm not sure if I missed the first part of the question. If you could reread it just really quickly, I could make sure I address
sure. It says,
specific.
Can you expand on the anti-blight program of family members of deceased veterans eligible to receive donated properties?
Oh, I see. So I think the distinction here is you mentioned deceased veterans. It does say relatives of deceased service members. Obviously, being deceased, whether they're classified as service members or veterans, I don't think would be dispositive. I think that certainly the family member of a deceased veteran could be eligible under the terms that are described here.
Okay. Next question is there a deadline for each state attorney general to decide how to use the funds?
There is no deadline. Each state attorney general will make their determination and will provide information to the escrow agent that holds the funds as to when they will draw down those funds and make a determination once those funds are drawn down as to how they will be allocated and used. So, as I mentioned, under certain state laws, there's already sort of a predetermined path for the funds, and it's just a matter of the state AG drawing them down. In other circumstances, the state AGs can draw them down and then make determinations at some later date. But there is no deadline for that.
Okay. Kate from Phoenix says, we have heard that 3 other banks have voluntarily joined the settlement. Do you know what this might mean and which lenders?
If that's true, that is great news. I would love to hear from Kate what 3 banks they might be. I think what you might be hearing, and certainly we have seen, is that a number of servicers have proactively begun adopting the servicing standards that are in the National Servicing Settlement, both in anticipation of either signing up to the settlement at some later date or of what they believe CFPB is likely to do, or with the recognition that if it becomes a standard practice to, for example, to have a single point of contact or change dual tracking, and that's the best practice, then they'll want to be providing that best practice to any institution whose loans they service.
Okay. Bob is asking.
No voluntary donations of cash payments or principal reduction that I'm aware of, but happy to hear that even the rumor.
That was very diplomatically handled, David.
Oh, thank you.
Bob is asking, if the house was foreclosed and bought under NSP program but still needs to be rehabbed and demolished, can the servicer get credit now since the house was sold a year or 2 prior to the date of the settlement, or just the houses they still have now?
So, as I understand that question, it would be the houses that they still have now, because it would have to be in their REO. I wasn't sure who sort of owned title after the sale that was described, but from what I understand from that, I think it's just the ones that are in their REO currently that would be eligible.
Right. I think you're interpreting that right, Damon. And just to add to it, one of the gaps that isn't fleshed out in terms of credit in the settlement agreement is a property that's conveyed at a discount. So many of you know that through First Look and other means, you were able to acquire REO over the last few years at a price point that was lower than the market value. Were that to even happen going forward, forget about the past, there is nothing, as I understand it, in the settlement agreement that would afford a direct credit to the servicer. It's certainly encouraged in that anti-blight language that I read earlier. Neighborhood stabilization activities and providing property at a discount is encouraged, but there is no credit per se in the list of credits that would be provided, other than for the donation of the property, the value of a donated property, and the funds contributed for the demolition of a potential property. So that is a bit of a gap in the settlement agreement right now, and I can only speak for myself here. The National Community Stabilization Trust, this does not reflect in any way the views of the federal government. We're talking to any number of parties about that and ways that we might be able to help clarify that provision, or at least encourage the 5 servicers and other servicers to voluntarily consider those discounts as a continuing important part of what they're doing to help re-net neighborhoods. After all, the more they contribute to help restabilize the market, the more value will be inherent in their future properties that are going through this process.
Okay. Next question. I also would like to ask about the bank's plans. Do you have a sense of the expectations around transparency? Will cities be able to obtain copies? We understand that we have a lot of latitude on choices of which states to work with and which tools.
So I did not understand that question, and I don't know if I'm just running out of steam here, but could you read that one more time just so I can make sure that I can address it?
The question is, she would like to ask about the bank's plans, and do you have a sense of the expectations around transparencies?
I got you. So this is on the bank's work plans going forward. My understanding is that because the work plans contain some proprietary information, that the work plans the banks consider confidential, and there are provisions in the settlement that allow them to designate them as such as long as the monitor agrees. I don't know where those discussions are between the monitor and the banks as to whether those work plans will ultimately be public or some portion of them perhaps redacted, but the proprietary information would be made public. Having said that, in terms of transparency, it is an ongoing discussion, certainly between the monitoring committee made up of 15 state AGs, HUD, and DOJ, and the monitor in terms of being able to get as much information out as possible. It's obviously helpful for those of you who are looking to make sure that the benefits that come out of the settlement have the proper impacts in the communities and neighborhoods that you're working in, and obviously it's important for the borrowers as well. Having said that, there is transparency that is set up in the settlement itself through the monitor's reports, which are all public. I understand the monitor is likely to be releasing sort of report describing work up to date. It won't be grading or judging the banks at this very early stage, but it will be providing some information and background as to the monitor's activities since the settlement was entered into in April. You can also go onto the monitor's website. The Office of the Settlement Monitor has a website at mortgageoversight.com. I believe it's www.mortgageoversight.com.
Okay. This is back to walkaways, and you may have answered it already, but what term is the servicers using internally to refer to walkaways?
Well, I think that there's nothing, I don't believe, Damon, in the settlement agreement that defines the term per se. So I think each of the 5 services probably have their own definition of that. And in fact, the term walkaway is not, I don't think, used at all in the agreement. That was my sort of term for it. They've often been referred to as walkaways or charge-offs over the last few years. So I think this is an example of many aspects of this settlement where there's still a lot to be determined, where your input can be valuable, where we all collectively can help the servicers figure out that work plan that Damon made reference to. And even after that work plan is established, we would expect that there will be further clarifications over time as we all together try to figure out how to make this stuff work and how we add more servicers to the settlement or to similar type arrangements.
I should also mention that on mortgageoversight.com there is a portal there. I think it's described as a portal for professionals in either real estate professionals or housing counselors, legal aid, etc., but I think is relevant for this crowd as well. It is designed to capture in an aggregated fashion any complaints or concerns about these banks meeting their obligations under the servicing settlement. And among the powers that the monitor has is the ability to take outside information, create new metrics by which the banks will be measured in terms of their implementation of the servicing settlement, and hold them accountable to it in the same way as the metrics that were sort of pre-cooked in the consent judgments themselves. So if there is on the servicing standards that are described, that were read earlier by Craig, issues that folks think are not being met by any of these 5 servicers, certainly would encourage you to go to that website and provide a description of whatever issue it is you're facing, so that that can become a part of this iterative process of making sure that this settlement is implemented in word and spirit.
Okay, there's a couple more. CP is asking, in his situation, Chase walked away 6 years ago. They now have reconnected with him to obtain title to this vacant building, I guess. It's a meth house. How does this settlement help us work with them?
So Chase has now reacquired title to the property?
It just says, we've now connected with them to obtain title to this vacant building, I guess. It's a meth house. How does this settlement help us work with them?
So if it's happened since March 1st and it's a donation of that property and the title was transferred, then it could be a property that is eligible for credit, that Chase would get credit for under the terms of the settlement. But beyond that, there's nothing additional in the settlement in terms of credit that the bank could get, beyond obviously the value of the property donated.
And I think it's important to underscore that these 5 servicers, they're large organizations, and not only are they still figuring out how they handle credit under this, how they earn their credit under the National Mortgage Settlement, but these kinds of individual activities, it would be difficult to link those activities to this broader settlement agreement. Better, I think, to either directly or you're more than welcome to work through us to engage the right people at Chase to try to accelerate any individual transaction wherever we can make that happen. Some of the major services have even said to us that they're not sure they're going to seek credit for each of the subparts of this settlement agreement. They may focus a lot of their time and attention on a couple of the major components like the principal reduction opportunity that Damon mentioned earlier. So a lot of issues there still, or questions still to be answered, but more importantly, I don't think it's going to impact individual decisions on individual properties, at least not for a while yet. This is still being assimilated by the institutions.
And I think just to underscore that, certainly our experience so far is that the servicers are concentrating on the principal reduction and refi, as I mentioned earlier, and not many of them have rolled out what I would describe a programmatic response to the credits they can receive under the neighborhood stabilization or anti-blight terms that we've been describing, and sort of in the informal conversations I've had, sort of have admitted that they are that is one of the things on their to-do list, but they have not yet gotten to it as they make the system changes and other changes necessary to comply with the settlement.
And I think, Damon, as we approach the top of the hour here, that's one of the reasons why the timing of this discussion was important. While some of the key elements have been digested by the institutions, they're still figuring out the anti-blight provisions, and so I think HUD was right, the NSP team, in scheduling this as a timely topic. A lot more information is going to become clearer over the next few months as our organization and other organizations engage the servicers in what anti-blight means to them, or how we interpret community stabilization and anti-blight provisions that would work on behalf of grantees and communities and still coincide with their obligations under the settlement agreement. We still have lots of room for further efforts in that regard.
Craig, we do have some hands up for verbal questions. We've got a few more in the queue for written, so we can switch gears and go verbal. If Jacob could unmute Robin Hurt's line.
And so, just to let you know, this is Damon. I have a 4 o'clock call, but I'm happy to take another 5 minutes or so.
Okay, Robin.
I hit my mute by accident. I apologize.
Okay, if you could just deselect your hand. Jacob, could you unmute Mary's, please?
Oh, this is Kate again, and the question, I did put my question in writing also, but it's banks have a lot of latitude in which things they do in which states, and I think you just alluded to it, and you may have answered part of my question, but are you seeing anything that says they will do certain things, say, in a judicial, non-judicial state, because they're experiencing higher costs in, say, Florida than they are in Arizona, but we both have negative equity issues?
So I have not seen data from each of the servicers regarding their activities that indicate how they're treating judicial versus non-judicial states. That being said, I note there are some benefits under the consumer relief provisions that are only going to be salient in judicial states. So, for example, there's a small credit that can be given to servicers for forgiving a deficiency judgment, and in most non-judicial states, at least the ones I'm familiar with, you, by going the non-judicial route, do not have a right to a deficiency judgment, and so we wouldn't see servicers trying to claim that credit there. Having said that, the banks are required to make determinations as to eligibility and to ensure that they do not have, unless they have some pilot program, and we are unaware of any, allowed to take geographic considerations into account when they determine eligibility, to make sure that folks in every state had equal footing when it came to possibility of benefiting under the settlement.
Yeah, and Kate, just to add to that, from our view, we are definitely seeing a higher level of activity of donations and even pre-foreclosure activity from the 5 servicers in judicial states. But I think that's more a function of, it's not wording in the settlement agreement as much as it is the knowledge that the properties are more highly distressed. Whether they're more underwater or not is maybe less a factor. It's a function of the properties have little residual value, and they need to do something more proactively with those properties. So we see a lot of that in Florida. We see a lot of it in the Midwest as well. But Jay, I think we're going to lose Damon here, our resident expert, and I don't want to lose the opportunity to thank him on behalf of the Trust and NDC for joining us, because you've been incredibly resourceful and very helpful to this dialogue, Damon.
Well, and thank you for having me and for the opportunity to speak to this group. And certainly if there are questions that we didn't get to, or questions that I had flagged earlier as needing additional response, I'm happy to take those in if they can be consolidated, and see if we can get responses out to participants. And certainly to the participants, thank you for the work that you're doing in the neighborhood stabilization efforts that you've been a part of. Certainly happy to help be a partner in that.
Oh, great. And Jenny, this is Craig. I've got a flight to catch here. I could stand for a couple more minutes.
Okay, I'd appreciate it. Who would you like the questions forwarded to? Do you want them funneled through us or through Tasha?
Tasha, what's your preference there?
Sorry, I was muted. I don't have a preference. They can come to me, or Jenny, you can collect them. It doesn't matter.
Okay.
Yeah, we'll be happy to respond to any in writing and get them back through the system.
Okay. Could we take one more phone call? Joan from Housing and Community Development Network.
Sure.
We could unmute her line.
Hello? Hello?
Hi, Joan.
Yes, Joan.
Hi. No, you answered mine. I ended up writing both of them, so thank you very much. You can go on to somebody else. I didn't realize at first you can also send it through this system, so I did both. But
okay.
You answered my question, so thank
you.
All
right, perfect. Just quickly, it says, Susan has a question. Please clarify, how does all of this specifically impact NSP recipients?
It's just another, my answer would be it's just another arrow in the quiver here. One more series of tools that we need to be knowledgeable and, I won't say proficient, but at least aware of, because it may, it's just another factor that's going to, I think, increase the level of responsiveness of not only these 5 servicers, but other servicers that, as Damon said, will ultimately sign up. I'm also hopeful that this will serve as a form of encouragement to the GSEs, since they're such a large investor, to adopt some of the same practices, so that when Bank of America, using them as just an example, when Bank of America is engaging in this activity, they will be able to get credit and have one delivery system for not only the portfolio product, the loans, the mortgages that they service directly and own directly, but would also get equal attention and consistency for the stuff where they are the servicer on behalf of Fannie Mae or Freddie Mac. So it's still a work in progress, but I think it's a very important contributing factor, both in terms of standardization of practices and at least opening the door to more dialogue with the servicers on anti-blight provisions. My frustration, I shouldn't ever end on a negative, my frustration is that there is not yet enough dialogue or clarity around the anti-blight provision. So our obligation collectively, the NSP grantees, and all of us working in support of the HUD NSP office, is to see if we can help the servicers through the settlement better understand neighborhood stabilization and how their activities, both in the recent past and going forward, are very should be consistent with the intent of this settlement agreement as well. That it all is driving towards the same purpose. They're not different activities for different purposes. That's our hope, at least.
There are actually just 2 more questions in the queue if you have a second, or a minute, I guess. As a grantee or non-grantee, how do we approach these servicers, and who are the servicers again?
Well, the servicers are that's easy. It's Bank of America, Chase, Citi, Wells Fargo, and Ally Bank / GMAC. How can you engage them? Well, you can engage, many of you already have a direct working relationship with contacts for those institutions. You can work through your local community development contacts for those institutions, or you're happy to work through us. And I think you all, at least those of you who work with us, know our community development managers, Don Stockmo, Raquel Reddy, and Sergio Barajas. But they have been briefed on the settlement agreement, and I would strongly encourage you to reach out to them. Or if you're working through First Look, you can reach out to your senior asset managers at the trust. And lastly, I think you all know our website, stabilizationtrust.com. Feel free to send a question in there, and we'll get it and try to help you in that regard as well. We can't solve all of these issues, but sometimes having allowing us the opportunity to echo a request or a concern you have with one of the servicers may just help things move along more quickly, and we're happy to do that on behalf of neighborhood stabilization programs.
And last question from Annie. What types of entities are eligible to receive donated properties from servicers? Nonprofits and municipalities, for-profits?
Yeah, it's really nonprofits and municipalities are identified in the settlement agreement. There could be ways that a for-profit perhaps could be the ultimate recipient, but that's not a clear path. But clearly nonprofits and quasi-public and public entities. Again, I'll reiterate something I said earlier, and that is the more we can develop a series of pre-qualified nonprofit and quasi-public buyers for these servicers, the more we'll be able to get this to scale, and the more I think we'll be able to leverage some financial contributions to go along with the properties themselves. That's at least our goal going forward here, to see if we can't have the donated property be another more significant component of the overall effort to get more property, more assets in the hands of local on-the-ground providers.
And that's all we have, Craig.
Great. Thanks, Jenny, for your help with this, and thank you, everyone, for sticking with us for over 2 hours. Any last words from Hunter or the HUD NSP team?
Yes. Oh, sorry, no, but thank you all for joining us.
Great. Thank you.